Hey, welcome to an episode of the Mark Moss Show. Now, this is different than in the content I typically put on YouTube. This is the Mark Moss Show, which I have nationally syndicated across the IHeart Radio Network, as well as my iHeart podcast. If you're not regularly listening to the Mark Moss Show, then I encourage you just to search Mark Moss iHeart, Mark Moss podcast. And I'm going to be putting an episode on YouTube so you can check it out. So you'll notice the format is a little bit different. Let's go ahead and jump right into it. All right, welcome to another episode of the Mark Moss Show, where we talk about Bitcoin, cryptocurrencies. We talk about the decentralized revolution, giving you the play-by-play so you can understand what's going on from a political, a financial, and a technological standpoint. You know, if you're only looking at one or the other, it sometimes gets a little murky. But when you look at them all together, things start to get a lot more clear. And it's pretty evident right now, the financial system that we have today is failing. It cannot go on much longer. Now, I say that, but I've been saying that for a long time. It can't go on much longer. How much is much longer? Well, we don't really know. A smart person told me that I can tell you what's going to happen, or I can tell you when, but I can't tell you both together. And so that's kind of where we're at. We can see what's inevitably happening, and we can see that we're getting closer and closer and closer to that. What that final event is, we don't know, but most analysts would have you believe that we are getting very close to that, and we can see the signs all around us. So, for example, this week we got the latest numbers from the United States government of the inflation numbers, or what they call inflation, which is the Consumer Price Index. It's called CPI. I like to call it CP-LI. And the reason why I call it CP-LI is because the way they use this number, they use this number for manipulation. And so the CPI, the Consumer Price Index, is a basket of goods. If in 1980 I went to the grocery store and I bought milk, cheese, steak, bread, and then every year I go back to the same store and I buy the same basket, and they would track the progress of that price. The problem is a couple things. One, they continue to change the basket. So we're not buying the same basket of goods over and over. So they're substituting things in that basket. Hey, you used to buy steak, now let's put hamburger meat. Hey, you used to buy hamburger meat, now let's put Spam or whatever. And so they change what's in my basket. And then they even just start removing things, and then they go into straight out lies. So for example, they tell you that the shelter went up by 5%, but in reality, nationwide, it went up by 26%. And of course, that makes up about 25% of the basket. So when they change the number that big, it changes the numbers, okay? That being said, the second problem that we have with CPI is that CPI, it tries to measure the prices. But we deal with prices, we interact with prices differently. So for example, if you're renting a home in, I think, Glendale, Arizona, the rent went up by about 108%. If you're renting a home in like Philadelphia, rents went down. So for somebody there, the CPI went down. Somewhere else, the CPI went up by 100%. If you're buying a home in Lake Travis and outside of Austin, Texas, it went up 150%. Some markets, I don't know which ones, I'm sure probably went up almost none at all. So inflation affects us differently, but inflation is, what they're calling inflation is really the price inflation. The price is going up of goods, services, and assets. Really, the inflation is the money supply going up. The money supply goes up, and what happens with the prices is the result of that money supply going up. And so the money supply goes up. The last 2 years went up by 40%, and real estate went up on average 40%. Used cars went up on average 40%. So a couple things. Now, back to the actual report, we saw that the CPI rises 8.3% year on year, and it's the first growth slowdown since August. So we've been seeing CPI go faster, and now it's slowing down. So it went from 8% to 8.5% to 8.3%. So it came back down from 8 to 8.5 to 8.3, and everybody's celebrating. A couple things about that are pretty crazy. First of all, they have CPI and then they have core CPI. Core CPI takes out things that you and I need to live, like food and energy. Actually, the two most important things that we need to live are food and energy, and they take those out of the basket for some reason. That's pretty crazy. But what I want to point to is that as this inflation has slowed down from 8 to 8.5 to 8.3, what that means is the price of everything has gone up. You know this. It's twice as much to fill up your gas tank. It's twice as much to get food for your house. It's twice as much to buy airline tickets, etc. When inflation goes from 8.5 all the way down to 8.3, it doesn't mean prices are coming back down. What that means is that they're still going up, just at a slower rate. So they were going up by 8.5%. Now they're still going up, but only at 8.3%. So it's not a reversal. It's not like things will get cheaper. It's not like things will get easier. It's not like your purchasing power will get better. It's just that you're losing your purchasing power a little bit slower today than you were yesterday. That's what that means. It's crazy. Now, because of this, now the economists are like, well, maybe it's getting a little bit better. Maybe we don't need to be as harsh and as drastic on our cutbacks. So the Federal Reserve has been trying to slow down inflation by, one, raising interest rates. When they raise interest rates, less people borrow money. If you're not aware, we talk about money printing all the time. The Fed, the government printed money. It's not really how it works. Over 80% of transactions are digital. Nobody's using really paper money. It's not really printing anything. And the Federal Reserve by itself doesn't even create money. All they do is give reserves to the banks, and then the banks with those reserves can create money into existence by issuing debt. So when you go to borrow money for a house, a car, an RV, a boat, etc., that money is being created into existence by debt. So when the interest rates go up, you borrow less, which means less money is being created into existence. So the Fed's been pretty aggressive on raising rates, some of the most aggressive we've seen them be in several years. And they raised half a basis point, another half a basis point, and many still believe they're going to continue raising rates, but the markets are completely melting down, and they may have to be reversing course here pretty quickly. Of course, when I talk about the markets melting down, everything is melting down. We've seen the NASDAQ is down, the Dow Jones is down, the S&P 500 is down. The big darlings are, Tesla's down, Coinbase is down, you name it, everything has come down. The crypto markets are not immune to this either. There is a complete bloodbath. A lot of it's due to this failing stablecoin protocol, UST, which I've been talking about quite a bit. I'm sure you've caught that. And that's bringing the entire market cap down. Considering how bad things are, dare I say that maybe Bitcoin is holding on okay? I know it's hard to say that at a time like this when we have this complete meltdown happening, but maybe it's not doing so bad. So we can see like Terra Luna's down 98% in 7 days. ApeCoin's down 66%. Thor is a big one. Avalanche 60%. Decentralized 55%. So Solana, the big darling, 55%. So a lot of these are really, really, really down 40, 50, even 60% just in the last 7 days, which is pretty insane. But we can see, Bitcoin seems to be somewhat holding on in light of that. Considering it's not a stable coin, it's down about 25%. So while some of the biggest cryptocurrencies are down by 50, 60, and even 70%, Bitcoin's holding on at about a 25% drop, which, doesn't make it the best, but it's still dropping down. We can see Ethereum's down over 30%. XRP's down over 40%, Cardano's down 45%, Solana's down 55%, Elon Musk's favorite Dogecoin's down 40%, and so Bitcoin holding on at 25%, not doing too bad all in all. And even while all this carnage is happening, there's still some bright spots on the horizon. We can see another nation is announcing that they're going to start buying it. Not another nation, but we saw news that Latin America's largest digital bank is going to allocate 1% to Bitcoin and offer crypto investment services. And so here we have the largest digital bank in Latin America that's going to start putting their reserves into Bitcoin. And we've seen through the stablecoins melting down that Bitcoin is a big beneficiary. A lot of people are buying Bitcoin. And I think now is still a pretty good time to get into Bitcoin. You buy when there's blood in the street, and that's basically where we're at right now. Now, should you buy Bitcoin now or should you wait for it to go a little bit lower? That's the age-old question. One of the best ways to get into Bitcoin is something called dollar cost averaging. And one of the best ways to get into dollar cost averaging is through mining Bitcoin. You can buy a high-powered computer, you plug it into the network, And by helping process transactions and secure the network, you earn Bitcoin. And I use a company called Compass Mining. They're the world's first and largest online marketplace for Bitcoin mining hardware and hosting. And they just released a new Compass Score. It's a new online product to help customers make an informed decision on their mining purchase. It's a 0 to 100 score metric that considers a bunch of different variables to figure out what your price should be, your hash power, where the price of Bitcoin is, and so much more. We can see here it says Terra Contagion leads to an 80% decline in the DeFi protocols associated with this. And so it's just starting to drag everything down. Like I said, I'm not going to go super deep into this. I already did a deep dive on this. You can go listen to the podcast version of this on the iHeart Network. Just search Mark Moss Podcast or Mark Moss iHeart, and you can check that out, where I really dug in deep to that. But what we can see is that there's a lot of contagion happening, and I'm afraid that what's happened with UST could then lead to USDT, which is Tether, and it could even spread to some of the CeFi coins like Celsius, because I see Celsius trying to backstop these, and it makes me think they have some sort of a vested interest in that. So be very, very careful of this contagion that's happening right now. And of course, a lot of people losing a lot of money, which then leads the governments, the regulators, to do what they do, which is regulate. And we have the SEC, Securities Exchange Commission, and their role is to protect customers. Their role is to protect people from this very thing. Now, I'm not a fan of the SEC. I don't think I need protection or you need protection. We should all be in a free market that allows me to freely choose what I want to decide, what risks I want to take, etc. And really, I'm a little bit mad at the SEC because they don't do anything to protect you. A lot of times what they're doing is actually hurting you. So for example, the rich get really rich because they get access to really good deals before they're public. So for example, some famous VC investors put like $25,000 or $50,000 or $100,000 into early upstarts like Uber, and turns into $20 million, $50 million, $100 million. Little bits of money, but maybe not you, but the average person isn't able to get in these types of deals because you're not an accredited investor. So the SEC is trying to protect you, so they're keeping you out of these types of deals. Meanwhile, the rich keep getting richer because they get access to these deals. And what happens is they get into all these early round deals and they make a bunch of money, and then finally they go public, which means the average person that's non-accredited can buy them. And so what happens? All those venture capitalists, all those accredited investors buy early, and as soon as they get onto the market, the regular people, non-accredited investors, have been waiting to get in. They can finally get in, and what happens? Well, those early investors dump on them. Sure, I already made 10x, 20x, 50x on my investment. Here you go, buy it. And usually, right after that happens, the price plummets down. And so the SEC, they say, are trying to protect the average person. The reality is more people end up getting hurt by this. However, can't fault them for trying, I suppose. Here they are again, back at it again, meeting at an ISDA meeting, and they're addressing the audience. It's an annual meeting of the International Swaps and Derivatives Association in Madrid, Spain. And Gary Gensler, he's the head of the SEC and the head of the U.S. Commodity Futures Trading Committee, Chairman Rostin Benham, were both featured as keynote speakers at the event, basically saying what they plan to do. Benham spoke at length about a, quote, request for an amended order of registration as a derivatives clearing organization by an entity seeking to offer non-intermediated clearing of margin products to retail participants. It's a lot. It's a big mouthful. What does that mean? That means they want to create more red tape and more gates that people have to get through before they can give these securities and derivatives for you to invest into, which is good. I think most people probably shouldn't be investing in these at all. But never, like I said, they're going to try to continue to regulate it. They're going to try to continue to protect us. And notably, Sam Bankman-Fried was there talking. Sam Bankman-Fried, you might recognize that name. He is I think he's under 30. I want to say he's like one of the richest men under 30. He's the founder of FTX Exchange. So FTX Exchange, I believe they sponsored, is it the Miami Heat? Stadium, possibly. Huge crypto exchange. He's a billionaire. He's there speaking about regulations. And here he is in another article talking about the scams that he sails. So he's there with the SEC and the CFTC talking about regulations and protecting people. But just a few weeks ago, he was talking about how the scams he perpetuates. So let me break this down. There's this Bloomberg article. You can find it. Just search Sam Bankman-Fried described yield farming. If you just look at that. So he says, anyway, this article is like, with DeFi, some of the most creative money making seems to take place in yield farming. You might be asking yourself right now, what the heck is yield farming? Well, a lot of people are. So in this article, FTX Chief Executive Officer and crypto billionaire Sam Bankman-Fried with Bloomberg opinion columnist Matt Levine sat down, and Matt asked Sam exactly what yield farming actually is. And here's what he said. You're going to love this. Matt Levine says, "Can you give me an intuitive understanding of farming?" I mean, like, to me, farming is like you sell some structured puts or whatever. So Sam Bankman-Fried, we'll just call him SBF for short. Remember, he's the billionaire that runs FTX, who was with the SEC talking about regulating. He says, let me give you sort of like a really toy model of it, which I actually think has a surprising amount of legitimacy for what farming could mean. You know, where do you start? He says, you start with a company that builds a box, and in practice, this box, they probably dress it up to look like a life-changing, you know, kind of like world-altering protocol that's going to replace all the big banks in 38 days or whatever. Maybe for now, actually ignore what it does or pretend it does literally nothing. It's just a box. Does that make sense? So right now, he says it's sort of like a box that they promise is going to change the whole world in 38 days, but it literally does nothing. It's just a box. That's his words. So you start with nothing, and they pretend it's going to be something, but in his own words, it actually does nothing. He says, so what this protocol is called Protocol X. It's a box, and you're a token. You can take Ethereum or whatever, and you put it in the box, and you take it out of the box. All right, so you can put tokens in, and you can take tokens out. So you put it in the box, and you get, like, you know, an IOU for having put it in the box. And then later, you can redeem that IOU back to get the token back. Does that make sense? You with me so far? So you have this worthless box. You can put a token in, they'll give you an IOU for it, and later you can redeem that for that token. He says, so far, this is Sam Bankman-Fried still, what we described as the world's dumbest ETF. It doesn't do anything, but it lets you put things in if you choose. And then this protocol issues a token, we'll call it whatever, X token. And X token promises that anything cool that happens because of this box is going to ultimately be usable by, you know, governance votes of holders of the X token. So basically, it's a bunch of smoke and mirrors. They create a box that literally does nothing that you can put tokens into with an IOU, and they promise you that whatever this box ends up doing, you'll be able to have a claim on whatever that box ends up doing because you have that IOU. However, he already told you that the box does nothing. And what we're going to do is we're going to take half of all the tokens, maybe 2/3, and we're going to offer those tokens, and we're going to give them away for free to whoever uses the box. So anyone who goes and takes some money and puts it in this box, remember the box that he said is worthless and does nothing, so whoever takes money and puts it in this box, each day they're going to get back, 1% of this new box token for everyone who put money in the box. Now for now, what X token does, it gets given away to box people. So this box that does absolutely nothing creates its own token, and if I put real money in there, they're going to give me back this box token. But what's the box? The box does nothing, and box token does nothing. For now, he says in his own words, what X token does is it gets given away to the box people. And now what happens? Well, the token has some market cap, right? It's probably not zero. Let's say it's, it's a 20 million market. So this box token that does nothing and gets given away to people who put their money in the box gets given away, and it's worth 20 million. And so the interviewee, Matt Levine, says, wait. From like first principles, it should be zero. And Sam's answer is, sure, okay, yeah, it's completely reasonable. It should be zero. So Matt says, wait, but like when you describe it in this total cynical way, it sounds like it should be zero. But go ahead and go on. So Sam says, okay, describe it this way. You might think, for instance, that in like 5 minutes with an internet connection, you could create a box and such a token. and that it should reflect like, it should be worth like $180 or something market cap for that, because of the amount of time and effort that it went. And he says that in the world that we're in, though, in this world today that he operates in, if you do this, everyone's going to be like, oh, Box token. Maybe it's cool if you buy in Box token, That's going to appear on Twitter, and it's going to have a 20 million market cap. Of course, one thing that you could do is you could like maybe make the float very low and whatever, and there haven't been $20 million that have been flowed in yet. So that's sort of like it. So what they do, what does he mean by that? So let's say that I have 1 million tokens in this box. So I create this worthless box and I create 1 million Box tokens. And people put their real money in the box, and I give them this worthless Box token back. I know it sounds insane. This is what's happening. What they do is then they say, well, we have these 1 million tokens, but that's how many are total supply. We're only going to put 100,000 into the market. That's the float. That's what he's talking about. Why would they do that? Well, supply and demand. If they make the tokens seem more scarce, then people want it more. And so you take the entire market cap of the token, and then you reduce the amount of tokens by what's available in the market, the float, and you artificially increase it. So the interviewer goes on to say, it shouldn't have any market cap in theory, but in practice, they always do. Okay. So it should be worth nothing, they're saying. And so Sam Bankman-Fried says, that's right. So, and obviously, already we sort of hiding some of the magic impact, right? So like some of the magic is like, how do you get that market cap to start with? But whatever we're going to move on from for that second, we have X tokens being given out to all these sophisticated firms. So all these Wall Street firms, and here's where the real scam comes in. So all these Wall Street firms, they're in on this. So you take this worthless box and these worthless box tokens, but you give them out to these sophisticated firms. Like if the total amount of money in the box is $100 million, then it's going to yield 16 million this year in Box tokens that are being given out for it. That's a 16% return. That's pretty good. We'll put a little bit more in, right? And maybe that happens until there's $200 million in the box. So, sophisticated traders or people on crypto Twitter or other sort of similar parties go and put 200 million in the box collectively, and they start getting these X tokens for it. So what he's saying, you create a completely worthless box and a completely worthless token box token. People then put real money or other tokens, Bitcoin, Ethereum, into this box, and they get this worthless box token back. They manipulate the markets to seem like there's value, and I'm getting 15% back on my tokens or my money in this box token, and then I can take this box token and I can go exchange it back for a US dollar stablecoin or a Bitcoin or Ethereum or whatever. Are you following along here? Does it sound ridiculous? It's because it is. That's exactly what's happened with US Terra Luna. So they've created this box, Terra Luna, and if I give them $1, they go and create Terra Luna coin, which is a worthless coin for a worthless box. They use their market makers and their Wall Street sophisticated traders to look like it has value, pump it up on Twitter, and pay back artificially 15%. Now, remember, if you, on Terra Luna, they offer you 20% interest. So a lot of people are going to take that. How do they pay you back 20%? They pay you back with a worthless box token. Look, this is what Sam Bankman-Fried is saying, all right? This isn't my words, this is his. Now, who's Sam Bankman-Fried? He is the founder of the FTX exchange, which is the largest cryptocurrency exchange. He's the same person at the meeting with the SEC and the CFTC that's trying to protect you from this exact scam. He's not trying to hide it. He's not trying to say like, no, this really has value. He's not saying that. He's saying it's a scam. He said, the interviewer says, I think of myself like a fairly cynical person, and that was so much more cynical than how I would have described it. You're just like, well, I'm in the Ponzi business and it's pretty good. That's what the interview asks him. They say, at no point did any of this require any sort of like economic case. It's just like other people putting money in the box, and so I'm going to too. And then it's more valuable. So they're going to put more money in, and at no point in the cycle did it seem to like describe any sort of like economic purpose. Yeah, so you're getting the point. That's exactly what this DeFi is. I know a lot of you may not like to hear this, and I apologize, because this may be the first time you're hearing something like this. But you've created a worthless box, and you've created a broken economic incentive system to get more people to put their real valuable tokens or money in a worthless box. And then they're creating a worthless box token to pay you back a percentage of your real money. And per Sam Bankman-Fried, in his own words, I read it for you word by word, it's a scam. Now, going on from that, what I was saying is that that's basically the way this is. They create a worthless box, a worthless token, and people buy it. And anytime you hear something being backed, what does that mean? So what is Bitcoin backed by? What is the dollar backed by? What is gold backed by? And what does backed even mean? So let's think about this for a minute. So for 5,000 years, gold was money. Gold fits most of the attributes of money: portable, divisible, durable, recognizable, saleable, fungible, etc. But it's not very portable. So it lacks that. It's not very good there. And so we put gold in the banks because it's too big and heavy and clunky to move over far space. We put it in the banks, and they gave us layer 2, a paper gold certificate. Paper certificates are easier to transport. It speeds up the velocity of money, but it's not money. It's a claim on the money. So what it is an IOU. If I were to give you that paper claim, that means you can go to the bank and claim that gold. So that gold-backed certificate was backed by the gold in the bank. Does that make sense? It was backed by the gold in the bank. But what was gold backed by? Gold's backed by nothing. Gold just is. Gold is money. Gold has value because everybody says it does. But it doesn't need to be backed by anything. So then the dollar was backed by gold, and then eventually the dollar became backed by nothing. It kind of went to the petrodollar, so dollars were kind of backed by oil. At least oil helped keep the price of the dollar propped up. They say today that the dollar's backed by the full faith and credit of the government, whatever that means. So really the dollar's not backed by anything, just this kind of collective illusion or trust that somebody else will accept it later for goods and services. And so the reason why I bring that up is because the very fact that something has to be backed by something else tells you there's a problem, tells you what you have is not the real thing, but rather a claim to it. Anytime you don't have the real thing, but rather a claim to it, it introduces risk. It introduces counterparty risk. So if I have the gold, I have the gold. If I give you the gold, you have the gold. If I put the gold in the bank and I give you a paper gold certificate, there's a chance that you may not actually get the gold. Remember the days of getting checks? You probably do if you're old enough. You'd get a check, and sometimes you'd wonder, like, will this check actually be good if I cash it? And typically it would always be good, but you know, people would bounce checks. I remember bouncing plenty of checks in my day, learning how to manage a checkbook. And so sometimes that check would not be worth it. Sometimes that claim, that IOU, would not be worth it. And so wouldn't you rather have the gold? And so whenever you hear this about these DeFi protocols, it's a box, it's a worthless box, as Sam Bankman-Fried says, and then you put these tokens in it, you put this money in it, and they give you back an IOU. They're backing that IOU with the assets in that box. But what if those assets in the box aren't any good, or you don't get them back? Then that IOU that you have, that claim, is worthless. And then it starts just cascading from there. And that's exactly what we're starting to see happen throughout the entire DeFi, decentralized finance market. And I think there's a lot of contagion there. And it's starting to pull down other assets like Bitcoin. So for example, Terra Luna didn't hold those dollars. Instead, they created this box token, their Terra Luna token. They also took some of those tokens and they bought over $1 billion of Bitcoin with it. And they thought, oh, we'll also back our token with Bitcoin. The problem is, as more and more people started coming to redeem that, they were forced to liquidate their box token, and their box token went from a $25 billion valuation, wait for it, from a $25 billion valuation to a $1 billion valuation. We lost $24 billion off the valuation, just like that. And because it was backed by something else, and then what it was backed by this Bitcoin, they were forced to liquidate the Bitcoin, and it pushed all this downward selling pressure on the market. And the problem is that we have so much leverage in the system, I'm afraid it could get worse. So for example, this contagion spread into all types of hedge funds, Wall Street traders. Potentially, I've talked quite a lot about Michael Saylor, MicroStrategy. They've used leverage, they've used debt is leverage, to buy an enormous amount of Bitcoin. And some people are speculating that these large Wall Street firms, these Wall Street traders, could potentially be trying to break that leverage. And so what happens is, I think he has about $4 billion worth of Bitcoin. You look at some of these giant hedge funds, they got $4 billion in their back pocket. They could easily just take that $4 billion, bet against him, start sprinkling a little bit of bad news, and bring that price down low enough to a point that it forces a liquidation event, which means he'd be forced to sell to cover the debt or post up more collateral. I'm not saying that's going to happen. I certainly hope it does not happen. But this is the problem that we get into from two reasons. We get into this problem from one reason is that this leverage in the system. Massive amounts of debt. So debt, unfortunately, had a very adverse effect on me in 2008. I've told my story many times about that. When the entire real estate market collapsed, I had too much leverage and I couldn't manage my portfolio properly. I like to think of leverage as like fire. Fire can cook my food and keep my house warm, but it could also burn my house down. It works that way. And so leverage would allow me to scale my business really quickly. I go get a bunch of new accounts, I go buy 10 new service trucks, I hire a bunch of new people, I scale my business up really quickly. But now, if something were to happen, I lose some of those accounts, business drops, now all of a sudden that leverage works in reverse because now I have 10 new trucks I have to pay for. I have all those employees I have to pay for. And so leverage allows me to scale up really fast, but then if I don't handle it properly and I don't know everything that could happen, it would also cause an unwind that I may not be able to handle. And that's what we're starting to see. We can see Coinbase Global, the publicly traded company, their founder Brian Armstrong had a personal fortune of $13.7 billion. As recently as a few months ago, and now that's just $2.2 billion. Now, don't feel too bad for him. He's just only worth $2.2 billion, but down from 13.8 to 2.2 that quickly. Now, that still sounds like a lot, but you don't know how much leverage he may have on those assets. So he had 13 billion. Let's say that he levered him by 7 billion, which seemed like maybe a pretty reasonable number. But now he's down to 2.2. If he can't cover the leverage on the 7 billion or the 5 billion, let's use a smaller number. I mean, let's say that he levered it by 3 billion. 3 out of almost 14 billion, that's a small number. That seems pretty reasonable. I think he should be able to handle that. But then it shrinks down to only 2.2. How can he handle that? Now, I'm not saying that Brian Armstrong from Coinbase has leverage. I'm not saying that at all because I don't know him, nor do I know if that's true. But you can see how quickly you can get yourself into trouble as that leverage unwinds. Mike Novogratz, CEO of Galaxy Digital, had a fortune of $8.5 billion in early November. Let's say that he levered it by $3 billion to go into Terra Luna, which he got the tattoo of, and now it's worth $2 billion, as says today. So again, that's how quickly you can get yourself into trouble. Particularly in these markets, like these crypto markets. But like I said, there's all this contagion that then it starts to pull down other markets as well. I learned the hard way, and hopefully you're learning from these lessons that I'm sharing with you. And it makes sense, but let me know. Hit me up on social media. You can find me at #1 Mark Moss on Instagram and on Twitter. I'd love to hear from you that you're listening to the show. Send me a question. I try to answer every single message I get on social media, so let me know on there. All right, hopefully you enjoyed this episode of the Mark Moss Show that I make for the iHeart syndicated national radio network, as well as the iHeart podcast network. You can just Google Mark Moss Podcast or Mark Moss iHeart. You can find the archived recordings there. And that's what I got for you today. All right, to your success. I'm out.